When this forum was actually planned around, I think I remember it was April of last year, I was in this job for only a month, and I was asked to put up a theme for this discussion, and we chose market connectivity and mutual recognition of funds. And at that time, I had no idea whether the hard work of my predecessor would be brought to fruition at that time. So I told my colleagues, well, let's have a plan B. Today, I'm glad that I don't have to resort to a plan B. We have approved 25 mainland funds under the scheme, and CSRC has approved 6 of last count. And so this has become probably the largest operating area for mutual recognition of funds, which I guess quite a lot of in this space of asset managers is something that they've been looking forward to. And there are other areas of cooperation which are working as hard to get a streamlined regime for funds to be authorized in different markets. Now, MRF is at the center of our strategy to enhance Hong Kong as a full-fledged asset management center with the funds domiciled and managed out of Hong Kong. Now, of course, in this immediate stage, we are trying to make it operational, make the implementation as smooth as possible, which includes the previous panelists touch on, that in cross-selling, in selling these funds across markets, you're into the host jurisdiction in which there are rules in KYCs and distribution which have to observe, and that's why this whole scheme is underpinned by supervisory cooperation between CSRC and ourselves. And when we have garnered sufficient experience, we would work towards a joint fund standard. And this is a dialogue that we are keeping with the industry constantly and also with regulators in order to refine the scheme. It's going to be a long haul and also to gradually expand it. So for the mainland, Stock Connect is an equally Stock Connect as well as this mutual recognition of funds connects mainland's capital markets to the rest of the world. And as we saw with IMF announcement of inclusion of renminbi into the SDR markets, we've seen further liberalization in QFII schemes, liberalizing both the quota administration as well as the remittance and repatriations of funds. Now, for asset managers, these developments should be very positive and open up new opportunities, but nonetheless, it also opens up new challenges. When we announced the MRF scheme on May 22nd, and by the time we launched and announced the first batch on December 18th, CSI 300 has dropped 24%, HSI similarly. So, but nonetheless, notwithstanding this difficult environment, CSRC proceeded with the launch, which says a lot about the market is still open to offshore foreign funds. Now, but nonetheless, these sharp volatilities and some of the intervention measures we've discussed in previous panel does expose the fault lines in the financial system and which they are trying to fix. The depreciation move in August of last year, also sent shockwaves to the rest of the world. So we are in a increasingly integrated world. And after going through a year of ice and fire, I think it's time to reflect on this concept and idea of China's connectivity to the rest of the world and the challenges it means for investments, for risk management, and for market access issues. Now, I'm very fortunate to bring together this distinguished panel, who will speak from perspective global, regional, as well as mainland. On my right is Mark McCombe. Mark is a senior MD and global head of BlackRock's institutional client business. I think, Mark, you flew the furthest to come here, 15 hours, and this is 2 a.m. in New York. Ding Chen is the CEO of CSOP and Asset Management Limited. And Evan DeBryan is the Chief Executive Officer of Schroders Investment Management and Head of Intermediary Business in Asia Pacific. And Bruno Lee is the Senior MD of Manulife Asset Management in charge of product, platform, and asset management. Now, I will kick off by posing questions to our panel speakers, and it will take around 40 minutes, and that will be followed by 2 polling questions, and I encourage all of you to participate. Hopefully, we have 10 minutes for Q&A in which you can send your questions to the website. So let me kick off by asking Mark the issue of investments. You were based on all 3 continents before, but you were well known in Hong Kong for your role at HSBC and also BlackRock. And then now you've relocated to New York. From an institutional investor's perspective, can you tell us about the concept of investing China as a market as part of the strategic asset allocation? And what does it mean given what's happened in the last year?
Well, Julia, thank you for the invitation to participate in this panel, and it's great to be back in Hong Kong. It definitely feels like coming home. I left Hong Kong about 18 months ago, and I thought I would just take a quick look at where the Shanghai and Hong Kong markets were 18 months ago versus today. And curiously enough, the Shanghai market is still up 30% relative to a year and a half ago, and the Hang Seng is down 20% versus a year and a half ago. So I'm not quite sure what that tells you, but maybe it means that actually some of the things that have happened in the last 18 months, we actually need to look beyond. And I would say that forms part of my kind of discussion today, is that I think, when you're up close and personal to a lot of what's going on here between Hong Kong and China and the opening up of the market, it very quickly comes into the details of how things are organized, the piping, the mechanics, the quotas. Moving to New York, I've had the advantage of perhaps stepping a little bit away from this market, but becoming very closely involved with some very, very deep pools of capital across the US public pension market, endowments, foundations, insurance companies, all of whom are really facing the same challenge, which is in a world of ever-depressed yields and the concept of lower for longer and ever-increasing liabilities, it becomes harder and harder to find the right investments to make long-term. And so obviously, this world of investing has focused for a very long time on the emerging markets, and we've seen for both good and less good flows in and out and volatility in the emerging markets. And then, of course, recently, in the last couple of years, and particularly the last 12 months, all of a sudden the Chinese market appears to have been thrust to the fore for what I would say are probably all the wrong reasons. So I think the overarching issue that I have is that we seem to have lost sight of the most fundamental question, which is, what is the strategic rationale for investing in China? We've become very focused on quotas and mutual recognition and access into and out of China. But the fundamental issue for an institutional investor, and frankly for any investor, is, does it make sense to invest into this market? And I would argue that actually there are a number of things that as regulators, as market participants, as commentators on the China market, that actually we should be very heavily focused on. And what are those things? Clearly, what most institutional capital is looking for is a highly efficient market. That's why the US has thrived, is because you have very deep pools of capital that are investing into very mature, evolved, and transparent markets. And that's been the basis upon which the capital markets within the United States and within Europe have developed. And so first and foremost, I think, alongside anything to do with the opening up of China or mutual recognition, has to be accompanied with a very strong focus on corporate governance and the rules and regulations that govern investing in that particular market. So I know you've had a panel this morning, and I would echo some of the comments that were made there, that actually when you think about creating an investment case for large institutional pools of capital to come into China and to stay in China, you have to think about the corporate governance standards, whether it's protection of minority shareholders, whether it's transparency, or whether it's creating a compliance culture. I think that's very, very important. And running along parallel with that, of course, is the need to develop China way beyond a retail market and into a fully fledged institutional market that is underpinned by very strong corporate governance and capital market rules and regulations. So again, I think in many of our discussions with policymakers in China, we would emphasize getting those foundations of a very strong and performing capital markets right, alongside any of the liberalization that goes into actually accessing the market. And then I think sort of wrapping around it is this concept of actually, I think I've used this expression a lot in the States in the past few months, which is that, you should never try to correlate the Chinese economy with the Chinese financial markets, because it doesn't always run in sync with each other. And I think that's part of the issue at the moment, that the destabilization in the markets in 2015 and into 2016, in my view, China was to some degree being used as a bit of a smokescreen for many other problems, ranging from sort of geopolitics, the decline in the oil price, problems in Europe, questions around growth in markets like the US, and just how QE was going to be reversed and the divergent policies between Europe and the US. All of that was playing to a great deal of fragility and sensitivity within the financial markets that, when you suddenly came out with a sort of lower growth in China and some volatility in the Shanghai market, you saw a massive reaction from the rest of the global markets. What I would say to people is that, it's not the right way to look at it. What you should be looking at are the fundamentals of the Chinese economy, and whether you believe long term that China is still going to be a major global driver of economic growth. The emergence of the middle class in a consumer economy is still a compelling thesis, and that actually China emerging onto the world stage is not only beneficial for the country and the region, but for the global financial markets as a whole. I think if you put that first and foremost alongside good corporate governance and the development of capital markets, that's what creates the base case for unbelievably patient capital to come into the markets, and that we can get away from this idea of constant hot money in and out, speculating on where the next turn of the Chinese policymakers is going to be, and focus rather on the fundamentals that will drive the economy. I think that's the main thing, that if as part of this mutual recognition we can focus on, then I think the future is very bright for China, very bright for the region, and obviously Hong Kong in its preeminent position here in this part of the world, that should be very good news also.
Well, thanks, Mark. That's very positive. But I thought Ding Chen actually mentioned that it's been a tough start for the year, and it's been a tough sale. I think you want to supplement just shortly what Mark said about your experience in selling funds to Europe or US.
Sure, thanks, Julia. It's great to be back to here. And throughout those years, when we're doing international business, we do realize that the foreign institutional investors, their concerns are different from, Chinese local investors. Besides looking for alpha only, and there are three factors, foreign investors, they are very, think is very essential. First is the balance between investment risk and investment return. Second is the overall the market transparency. Mark just mentioned a lot. And third one is also Mark touched, is like the corporate governance. So I think for us, by doing business in Hong Kong, knowing the concern, the foreign investors, I think very important. But also very important is like we monitoring our clients' investment behavior, and then we can, deliver better product or service to them. From my observation, before last year, because of various reasons like asset allocation or investment needs, we see a lot of asset owners like sovereign wealth fund, endowment fund, foundations, insurance company. They, buy our listed ETF here to get access to China. But since last summer, because of the turbulence, because of the lack of the transparency of the market, we experienced a major risk off of the China A market. But the good news today is we slightly see some positive changes. For instance, for the last month, for our listed ETF here, 2822, we see roughly 3% new fund flow to our products. We see some clients really begin to risk on of China A market. And also another interesting observation is from time to time, we regularly doing some investor education in US, do webinars. For the last 1.5 years, normally each time we do the webinars, the people attend the webinars only around 400 people every time. But this month we did a webinar, this time we got 800 people. And also because we got 800 people, we say, we do a little bit survey on that part. So we asked the audience, what's their own view of China A market. So surprisingly, we got 5% people say they are very bullish on that one. And 45 people say somehow, somewhat, they think China A, there's some sort of, investment. If they say pick up top 3 investment place, they will pick China A. So roughly 50% of the people think, China A, there's investment opportunities. So yeah, just echo Mark just mentioned. So investing in China, I think we have to be patient because it's really a developing market.
Yeah. I think you both make the point that it has been patient, long haul. I think the most important thing is to improve on the corporate governance. It's not just the opening the channels that matters. Exactly. It's also the governance standards. Now let me turn around to ask, because market connectivity is both ways. That is, both the stock connect and the mutual recognition of funds also involve the other direction, fund flows from the mainland to the rest of the world. And as we know that there are some bright spots in that area, as we see in the steady increase of the southbound flows through Stock Connect, and also the initial signs of sales of the northbound funds, that is, those who are under the mutual recognized scheme, seems to be satisfactory. So do you think that mainland investors are truly diversifying, and in the longer, maybe take away the noises and look into longer term, whether mainland investors are really attracted to fixed income equities in the US and Europe, or they still have this home bias and want to buy more of the same from shares in Hong Kong market? So Ding Chen.
Yeah, so it's a $1 billion question. So if you understand 1.3 billion people thinking, and with whole, as a very rich, it should be a very rich country, so you're gonna have a lot of business. So this question reminds me of a recent survey BCG just done in August last year. The surveys, I can show you some statistics here, and probably can help me to answer the question. First of all, in 2015, China's private wealth will reach RMB 110 trillion RMB. So it's roughly 18 trillion US dollar. And among the survey, they said demand for overseas asset allocation has been increasing rapidly. And also in the survey, they asked whether the high net worth they have experience in overseas investment. Very surprisingly, 8% they say they have overseas investment experience. 34% says they have some experience, very minor experience in overseas investment. And 58% of high net worth in China, they say they never have any experience in overseas investment. And also, very interesting, and also to answer your question about those instruments. So for most interesting assets, the high net worth they are interested is also stocks, real estate, and structured products. So I guess those accumulator or accumulator products still very popular in China. And most interesting regions, if you pick up investment regions, they say US, Hong Kong, it's very good with Hong Kong in there. And also very surprised me is the third one, they say Canada. I guess the reason for Canada is because Chinese people, we love to buy real estate. So a lot of immigrants in Canada. So I think Canada is because of that, they can get in. And before we jump to conclusion, I can still do a little bit math because Chinese people, we are good at math. So whether, Chinese people, they are diversified, to oversee investment, we can see the channels. The QDII is like 90 billion US dollar, right? And the mutual recognition is 300 billion RMB. The stock connects 250 billion RMB. Counts on all this together, it's like roughly is 1 trillion RMB. So with all these channels fully utilized, this counts on like 1% of the private wealth. So that means in this house, everybody, our job is very secure. So we have a big market. That's the good news. But the bad news is, Chinese people, you have to do a lot of, investor education because 58% of the people, they never touch the overseas investment. They don't know anything about that. So I think for that part, there definitely will be a lot of work to do. And from my point of view or, my experience over these years, I think definitely for foreigners, you have to find an appropriate partner in China because China is so big and so different. And even myself, I was always joking, it's like if I go to Shanxi province or Hunan province, I definitely need somebody to translate. Otherwise, I cannot know anything about that. Even they are talking about numbers. So it's really frustrated. And because Chinese people, we are, really, because of the, the currency depreciation for this year, a lot of Chinese people, they are beginning to think about diversify their assets to doing some, overseas investments. They need education. And for the institutions, I think Chinese institutions, they are getting more and more sophisticated. They need help from the overseas partners. Obviously, for them to pick up the partners, I think for us to be a partner, we definitely need to have very clear strategy, long-term, be patient. And the best thing is if you have a good brand, that would be good because we love, we not only love luxury goods, but also we like the superstars. Yeah.
Okay.
So.
Leave it. Schroders has a lot of experience selling to different markets in the region. I mean, what do you, just a few supplement on what Ding Chen said about selling into the mainland market, particularly, I think you are setting up some operational and distribution and stuff. What are the things that you would pay a lot of attention to?
Yeah, I think in a way it's the encouraging thing. It's about two things. It's about the availability of product, and it's about the customer experience. Now, the availability of product is, I think, going to increase substantially with mutual recognition over time. Mutual funds and international mutual funds have been available to mainland Chinese investors through QD for a number of years. International banks have been able to sell offshore funds for a number of years, but they are obviously relatively small in footprint particularly, and therefore it's a very small percentage of generally more ultra-high net worth Chinese individuals who've been able to buy these funds. And I think being able to make foreign firms, funds available across a wider range of banks and local distributors is going to make that experience and that availability so much bigger and better. Now it will come with that customer experience. It's about the education and making sure that people understand what the advantages are. It's easy, in a way, for us to sit on stage here and to understand it. But how do you convey that message? And the only thing I can say, what really encourages me is not so much that we, as a company, as a fund manager, get very excited about it, but when we talk to our distributors and We hope to be the next approved fund northbound on mutual recognition. We're not there. We're still waiting.
Me too.
So if the press can pick that up. The discussions we have with a range of distributors there, we have agreed, once we get the approval, that they will carry our fund through mutual recognition. That's what really, I think, has changed. And it's changed prior to August, when we saw the first market correction, but it hasn't changed since. And I think many of the domestic banks in China have really signed up to making international funds part of their financial product offering. And that, I think, is the most encouraging side.
Yeah. Now, I want to move to the next subject. I mean, increased connectivity with the capital markets also means that you're subject to some liquidity risk from the exported from the mainland. Now, globally, regulators are concerned about the run risk of mutual funds. Mutual funds offer daily redemption, and whereby the underlying portfolio may not be as liquid. So in this part of the world, our regulators' concern for liquidity risk was heightened by the events of last summer, whereby, particularly on the 9th of July, more than 50% of the A shares were suspended, with much of the rest having hit the price floor limits. So de facto, there were very little liquidity in the A share market and also in the fixed income market. So even though none of our authorized funds during that time were suspended at dealing, the episode actually raised very important issues of fair valuation of investment funds, and some of these funds just sold the most liquid assets, and that to meet the redemption needs, leaving very illiquid assets in for the existing customers, investors. So I think this phenomenon is not just confined to the mainland. These issues are across the board. Market dislocation with the end of QE, you will see just more of this continuous pricing. And we are seeing increased redemption pressure and significant outflows from investment funds in the last few months. So those of us as asset managers know that we've been reaching out to the industry to see with a view to providing more guidance in this area, and know that Levin has shared with us previously the shoulders experience, and perhaps you can share with us now what the practices in the dealing with this liquidity risk, particularly in the last few months.
Thanks. So this was obviously a prepared question, and so I went back to some of the notes.
To make it sound spontaneous, come on.
I went back to some of the notes that we put on file on some of the discussions we had with SFC and regulators across the world, because clearly liquidity and how we deal with liquidity in funds is something that's global, but became very pertinent here in Hong Kong in dealing with the events that Julia was referring to in China. And there are a number of things that obviously market-related, regulatory-related, but there are a number of things also that fund managers can do themselves to, I guess, contain some of these risks. And I would kind of run through them one by one. So when we look at liquidity risk, generally the risks in portfolios, we look at it apart from the market volatility and what it drives in terms of the assets, and that's really to do not just about liquidity in the portfolio and the holdings themselves, but it's around asset allocation and the general risk profile of products, as well as the liability side, and that's more defined in terms of redemption profiles of funds, investor concentration, etc. And some of the metrics around that are, if we look at these asset indicators, clearly that's around trading volumes, bid-ask spreads, etc. There's a lot of predictive value in the market information you can derive, and therefore to think through about what possible effects that could have on the redemptions or on the trading patterns in your funds. The funds themselves you can analyze as well. So you can look at your fund performance versus peer group or benchmark. Clearly, when you are going through a period of strong underperformance, history shows that the likelihood of more significant redemptions clearly goes up. You can look at the redemption policies within funds, which can differ, and you can adjust them to the extent necessary. And you can look at the flows themselves. Very often patterns of outflows start to materialize and then increase. They don't come overnight. And if you start seeing those pick up, clearly you in the portfolio you can start making provisions for that. I mentioned already investor concentration, and that's really to think through who do you sell the funds to, and how do you ensure that it's just not, let's say, it could be a geographical decision, not just in one country or not just through one distributor, but you diversify that. So particularly when you're talking about discretionary assets, where a third-party distributor might have made an allocation in your portfolio, which they can, with one kind of asset allocation decision, withdraw. That's a much higher risk on your overall liquidity in your portfolio than if you have a diverse set of distributors with discretion as well as advisory money in there, which generally would mean a much more generic and general withdrawal of assets. Then there's obviously a lot you can do as a company and how you structure yourself in terms of dealing with these liquidity risk issues. So in Schroders, it's overall managed through the group investment risk management policies we have in place, but there are really three lines of what we call the three lines of defense. And the first line of defense is really the investment desk. It is a responsibility that every portfolio manager has in terms of how they look at building their portfolios, including the research department and the analysis we do on a stock or bond level and the general liquidity in that. And I'll come back to that in a second. The second line of defense we use is then group risk. And if there's one area I think every fund manager has really invested in and expanded in, it's risk and compliance. But that's really become a very substantial part of how we run our business on a day-to-day basis. And they have a big, big role to play as kind of once the portfolio managers have made their decisions in the portfolio to look at risk on a regular basis. And then the third line of defense is really our more group internal audit procedures that provide kind of more periodic assurance that the effectiveness of the controls and et cetera that are in place are working properly. Now, there are some challenges around this, and I think there are three particular areas to mention. I'll end up then coming back to China. And the first one is around this client, concentration of clients in the funds. We do monitor on this ongoing basis, but you can't always steer that to the extent that you want. And certain products will have more demand, let's say, in a home market or in a certain channel because it's just a greater attraction. And so we really then think through what are the fund's mechanisms around redemptions, what can we do to avoid, obviously, having to put a gate on. Many of our funds can't take redemptions over 10%, or at least you can gate at 10%, but you would like to avoid it, even if redemptions would be in excess of that, that you would actually have to gate. The reality is, though, that many of the funds we do provide to our clients are generally investing in very liquid markets and in liquid instruments. And the number of occasions where you really have to deal with such extreme outflows are very far and few between. And even if we look back at the global financial crisis, we had virtually no issues in our funds to deal with this liquidity issue. So it has to go to real extremes before funds get into serious problems if you manage them along the lines I've just described. Coming back to the portfolio concentration, there are a lot of minimum standards that are built in that, again, force diversification and force fund managers to look beyond a too concentrated portfolio and do the analysis on the screens on the various investments they will make when you get to a stock coverage list, bond coverage list, etc. So a lot of the work is done prior to actually getting these holdings in a portfolio. Then finally, on the market liquidity and suspensions, this was a bigger issue in China recently. If you get a situation where half the market gets suspended, obviously we've had some very, very lengthy discussions about what we do about striking an NAV. And particularly if that happens, I think it was less than 40 minutes into a trading session, clearly with a market where there's very little in terms of proxy pricing, it becomes a real challenge. And so clearly the suspension subsequently of the abolishment of the circuit breaker is something that we thought was the right thing to do, given that the way it was structured was obviously not working. It is also our understanding that the CRC is now actively looking into avoiding that this kind of event would reoccur, something we strongly support because it does obviously make it almost impossible to come up with the proper pricing for your funds. But in many ways, the Stock Connect is helping us with some of the liquidity and access beyond just your quota. And again, if we now, next to Shanghai Connect, we get Shenzhen Connect, all these kind of initiatives really will help to improve the liquidity in the China market and to, I guess, avoid some of the issues we had to deal with earlier this year. So I'd leave it at that.
Yeah, I think Levin sort of covered everything from portfolio construction, concentration, redemption tools, and valuation. I think fair value treatment is an important part of that risk management. Now, Bruno, you have a quick supplement on this issue?
Well, I think on top of what Levin mentioned, I think one of the potential implications in terms of this kind of volatility market or these large-scale suspension is the fund management or portfolio manager will be more reluctant to allocate more of the asset into, for example, in China, will be the growing area, will be different from the old economy, but they do see potential opportunity. But with the kind of uncertainty related to the redemptions, price discovery and all this, that could limit the opportunity for the managers to put money in the place or in the stock that they think have long-term growth opportunity, but with less liquidity. So I think that's a kind of a potential consequence. Mm-hmm. So the more they concentrate in the highly liquid stock at the moment, I think these are more related to the old economy. So I think that also defeats the purpose of the active investment, kind of capability, and making it maybe not as efficient, as it normally would be.
Let's move to the third and last subject of market assets. We have a panel which have global asset managers which have multiple means of accessing the mainland market. So basically, there is you can set up a joint venture asset management company and then selling funds on the mainland, but then you don't have, you usually have a 30% stake, you don't have majority in management control. Or you can have management control with setting up a wholly owned enterprises, a WOFE, to conduct research and provide advisory service, and perhaps a license to investment management for private funds at this point, but don't know whether it will develop into a retail fund. Or you now, with a mutual recognized scheme, you can actually set up a fund platform, bring your fund platform to Hong Kong and sell cross-selling to the mainland. So there seems to be multiple channels, and I would ask Bruno to elaborate on, and also you also have this old-fashioned and UCITS still has a very good brand, and it has a passport status with quite a number of multiple countries. So I just pose the question to Bruno, how do you evaluate this multiple business options?
The market access.
Yeah.
Yeah, I think in terms of the market access, one thing we have to give credibility to, both Hong Kong and mainland, regulator. Throughout the years, these multiple bridges has been built to access the market and to allow the mainland investor capital flowing out to diversify into other market outside of the mainland. And I think given what we have been seeing in terms of the current challenge, the important thing is we should not slow down this kind of reform. The argument is mainly from two angles. On one angle, from to attract more international institutional asset managers to come to China is very key for the continuous reform and strengthening of the best practice, and also to bring international capital in China. I think so that's very important to allow in those multiple access points, how can we look into further relaxation or reform to give more confidence and more control for the foreign players to participate. From the other angle is from the investor angle. What we have to recognize is in China, the wealth are building up tremendously fast. And if you try to limit the the type of assets that the local investor can invest in, whether it's property, and then after property bubble, you move to stock, after the stock market popped, and then you go back to property, then there's not much room to grow. So as Ding Chen mentioned, even all these access programs account for 1 trillion RMB, and it's just 1% of the private wealth. So it is important to continue and not be afraid of continuously opening up the market to allow these capital from the private wealth to be able to access the overseas market. And by doing so, it will not only allow the individual investors to diversify the risk, but also to allow the local player, the asset management industry, to also develop because they have to learn how to invest globally. They have to basically put research team in place in different parts of the world, and that will help them to understand how to enhance their overall research capability. So I do see from the previous history in US and other markets, every crisis leads to an opportunity. So all major regulations enhancement back in the US in early part of 1990s, the Great Depression then lead to a lot of the changes, which are good for the future. So at the moment, I think really right now, even though we're facing a lot of challenges related to this access program, but I think there are 5 different opportunities related to this access program. First of all, it's just too complex. When you look at the so-called QV, RQV, QDII, QDLP, MRF, and all these, Stock Connect, it is just way too complicated. So I think there is an opportunity to try to streamline and align some of these so that it will make it easier for people to really understand, so what does that mean in terms of all these access program. And of course, it all has its own purpose, targeting different segment of the investor, for example. But I think there are opportunities to streamline them to make it easier for people to understand. The second opportunity is about the debt market. I think Charles mentioned this morning about the debt market. I think across the world, people are looking for yield. So historically, people in this part of the world in Asia are more equity oriented. But given the market volatility, I think there's a huge opportunity to look at debt instruments, particularly from China. And I think this morning, the panelists also mentioned about some of the constraints in terms of accessing the interbank market and accessing the market, creating the government bond yield and so forth. So in terms of access program, I think there need to be a little bit more focus in terms of not just equity, but what about the debt and fixed income market to try to diversify and to fund the necessary capital structure development in China. The third opportunity I see, going back to the mutual recognition of fund, at the moment, I think in the first phase, there are some restriction which can potentially relax so that can encourage more participation to or fund manager to participate in that. These are particularly related to moving away from the micro quota to the macro quota. For example, it requires the fund, if it raised maybe 500 million in Hong Kong, in the Hong Kong domicile fund, it can only raise up to the same amount in mainland China. So, the question is whether this is necessary, because there are a lot of fund managers with good capability that may or may not have the existing vehicle set up in Hong Kong. So these good capability can be marketed within mainland China if this kind of one-to-one matching restriction can be removed, but rather to look at the overall aggregate quota perspective in terms of northbound and southbound, and in terms of the one-year rules and so forth. I think so there may be some fine-tuning opportunity to encourage more participants to participate in this MRF program. Because the work need to be done to educate the mainland Chinese investors is huge. So the more participants to put more resources in it will be potentially benefiting the whole program. So the fourth one is the JV. I think right now, except for a company through the SEPA arrangement, I think the shareholding limit is still below 50. of the JV. So I think this is, again, another opportunity to potentially look into relaxing this JV shareholding limit to allow foreign firms to have a much higher ownership, to the extent of eventually getting 100% ownership in mainland China, and to be able to conduct the business and launch the product in China, which will also complement the existing local industry to provide people with more confidence about investing back into either China or overseas through the wholly owned subsidiary. Because right now the WOFE, my understanding is only targeting to those private placement, high net worth, but not to the retail market. And then finally, I think one is very key areas related to the infrastructure's pension reform. Because if people are always relying on discretionary investment, so 80% of the retail customer in China, when are they going to be more likely to start thinking about investing? Is when the market go up. But when we see, kind of the U.S. market, for example, without 401k, without IRA, the U.S. fund industry will not be the U.S. fund industry today. So I think China, has a huge opportunity to look into setting up some sort of a DC type of, long-term pension scheme, which will drip feed, the money, channel the saving gradually into the capital market for those corporations who need the money. And rather than relying on, kind of the big swing in terms of discretionary investment, buying at the peak, selling at the low, it's too difficult to do for the retail investor. So I think developing a disciplined, regular investment through this pension reform could be opportunity to further enhance whatever we already have in this kind of access program. And finally, I just echo what Mark said about the fundamental, about corporate governance, transparency, hopefully, kind of a stable rather than surprise, kind of a regulatory change and policy, I think will help to stabilize the market. I think what we need is, kind of confidence in the market. I don't think anyone would doubt the long-term investment opportunity in China or the growth opportunity in China. But I think in the short term, I think we do need to have some stabilizing, kind of effect in the market by having these fundamental being in place.
Yeah, thanks. Mark, you have anything to add? And then BlackRock has both joint venture asset management company as well as a WOFE. So any tips on your business?
Thank you for doing that advertisement of what we do in China. Very quickly, I think a couple of observations that maybe wrap up some of the points made by the other panelists. But it strikes me that there are three things that China really needs to focus on, which are really around confidence, efficiency, and transparency. We've talked about the transparency of the markets. We've talked about having a more efficient system of capital flows both ways. And perhaps the one that, Bruno's sort of picked up on that I think is important is really around confidence in the long-term fundamentals of the capital markets as opposed to, the economy and the investment thesis itself. And, I was just reflecting as we were talking about how, oddly enough, you could draw some parallels with different markets and how they've evolved over time. And, if you take the example of India, India was much further ahead of China in opening up its fund industry to international capital. But I would argue that it stalled along the way, and it stalled along the way because I think there was a fundamental disconnect between what was happening in the retail mutual fund space and what was happening in the institutional capital markets. And so I think there's a lesson there about creating an environment in which institutional capital feels confident about the long-term fundamentals of the economy. And then interestingly, maybe going even further afield, since Bruno gave us a quick history lesson, but there's one of the founding fathers of the US, the first Treasury Secretary was Alexander Hamilton. There's a very good biography on him at the moment that is quite a 800-page tome. But one of the things that was fundamental in the creation of the US Central Bank was really this question of creating a very open and transparent capital market where foreign capital was treated in exactly the same way as domestic capital. And the fundamental question of unifying all the state debt into one national debt that would then give the US the ability to actually leverage itself into the international capital markets was really what underpinned the growth of that economy. And we can see what's happened over the sort of 200 years intervening, good and bad. But I guess the point to mention here is that actually fundamentally China, if it has confidence in its future and confidence in its capital markets, that's what will allow international capital to come in and to be patient. And I use the word patient because I think fundamentally that's what we've suffered a lack of in years gone by, is that people get nervous and they pull their capital out. And at the end of the day, that international capital is highly dynamic and highly fungible. And so people will vote with their feet and seek other opportunities if those are felt to be more opportune at that point in time. So I believe that if China can have that confidence to go forward in a very open, transparent way, I think it's good for international capital markets and ultimately very good for the global economy.
Right, the message is very clear from Mark. Corporate governance, confidence, transparency. Now, before I open the floor to questions and answers, let me quickly highlight the two polling questions. Could somebody put it up on the screen? You just have to access it through your smartphone and give a vote response. The first question is, apart from mainland China, what do you think is the biggest potential market for Hong Kong domicile funds? First one is North Asia or Southeast Asia, major markets in Europe and USA. Now, it's kind of hard to sell to the retail in USA, but this is a wish list, so you wish what you wish for. The second question is, you have from now till the end, just before the end of this session, which is 8 minutes, to vote. The second one is, what is the most promising China strategy for fund managers from outside Hong Kong? That's the question I posed to Bruno. A is to start a Hong Kong fund and cross-sell through the MRF scheme. B is to invest in a joint venture asset management company via MRF. The third is starting a WOFE. And the fourth is, which all of you told me that you wish for, is wait patiently for mutual recognition to be extended to UCITS by the mainland. So now I will leave it up to you to vote, but there are already questions. Questions. Asset managers need to work harder, just like selling funds in Hong Kong would not do. Selling UCITS funds just. There are questions from the floor which are very closely related with what you just said. A few of you will say. The three questions are actually related. So it comes from three different questions, and they are real questions, Levin, not planted ones. And the first one is, why is the institutional investment in the Chinese equity market so low, and when will it pick it up? Why is it's 80% mom and pop retail, and this retail has driven a culture of pursuing a quick return. And this is not what Mark is looking for. He's looking for longer term. It seems that, and related question is, back in 40 years ago, US was still very much retail investment driven. So whether any panelists can share with us what the US did to make that change, and do you think that China should make the same move, and if so, how? So it seems like it's tailor-made for you. And the related questions actually, it's both Mark and Ding Chen mentioned the need for patient capital to be invested on China. And how is it going to be achieved with all these performance demands on fund managers are so high? I think that meant globally. So,
well, let me just take one angle of it, because I think the issue of how do you get institutional money working through a capital market system, one of them is obviously the disintermediation of the banking system. So clearly, China has been built very much on a very strong banking foundation, which means that access to the debt markets has not necessarily been what's financed corporate growth. I think if you contrast that with America, where there was a massive sort of post-war disintermediation of the banks, and so there were other sources of capital that were found, that was a very good and stable alternative source of capital. So I would say that, does that run contrary to sort of historical policy of how China's economy has been managed? Probably to some degree, but certainly from conversations that I've had with policymakers, it seems that there is a willingness for the sources of capital to become very diversified. And then obviously how that capital is put to work through the capital markets structure. I think, again, China has demonstrated very effectively that they're willing to see alternative participants in the market. We saw Alipay obviously was a very high-profile example of where a new entrant came in and occupied a part of the market that might have been held for other participants. So I think that ability to regulate very strongly but allow the sources of capital to be diversified would be one way to promote institutional fund flow.
Yeah, I guess I supplement a little bit. I try to answer the first question: why there is so little institutional investor in China. So we have to see the Chinese capital markets look at it in this way. So it's set up in 1990, early 1990. So totally in China, the capital markets only have like 26 years old. So for the mutual fund, the first mutual fund set up in China is China 1000 Fund. It's only like 17 years old. So by given such short period of time, and the China capital markets, especially the equity market, becomes the second largest capital markets in the whole world. So we can expect that the history, the time is too short. And also, Mark just mentioned a lot of the institutions, like we say, like endowment funds, foundations. We don't even have those things in China right now. So for institutions, like right now, it's like only pension, only insurance company, mutual funds. So for the insurance companies, it's very important in China. But right now, the insurance company can only allow their, among their asset books, they only allow them invest like 15% to the domestic markets. So that's why all of these things, I think, is because China capital markets, the history is too short. And that's also answered another question, is why we should be patient. So that's why we should be patient. So because China capital market is still in the, I wouldn't say infant stage, but it's still in the baby stage. So we have to be patient. And I think if you stay at that market longer enough, learn more, and you definitely get reward. Just like 1 to 2 years ago, I talked with my colleagues in China, my friends in China. I say, right now the QDI, nobody wants that, right? So you guys should, learn and also participate in that market. So someday, somehow it may change, because right now everybody wants to rush to RQFI, QFI. Now, since change, everybody wants QDI and the RQFI, QFI. QFI right now is like unlimited supply. So if we can, take this advantage, and then I think the market will definitely reward, because it's 1.3 billion people over there. The private wealth is like 110 trillion RMB, and we even don't count on the institutions' wealth. It's a huge number. Yeah.
Yes. Levan, you have.
But I think the one thing I would add is that you do have to be a little bit careful to compare trading volumes with end investors. So we know that the retail client just trades a lot. There is obviously quite a percentage of institutional money in there as well, which is a bit more stable. But it comes back to something that was mentioned earlier around how do you get people to understand longer-term investing. And I'm not surprised if markets actually has periods of very strong performance, that there are a lot of investors in that who just want to have a quick gain, and therefore buy a fund through generally a bank for the very short-term game. And this is part of how do you educate it and how do you diversify the availability of funds, not just the kind of funds, but also how you can buy them through advice. And I think our prediction is that China will be one of the leading countries in the world in terms of technology companies coming in and becoming an alternative to the established banks in providing not only financial products, but providing it with advice and a really good customer experience, not just in terms of what you pay for it in fees, but also in understanding and building a portfolio and able to see what that portfolio looks like, being able to track it, and hopefully understanding that on the long term, me trying to avoid to buy high and sell low, that in the end is a much better outcome. And in a way, because China is still in a very early stage of development, this could be a real advantage as technology enables this to happen. So from that perspective, I'm not surprised what we've seen so far, but I wouldn't be surprised if we see it change much more rapidly than we've seen it in some other countries across the region.
Bruno, you only have like 5 seconds.
Well, I think you know, kind of the key thing is more focusing on the right regulations, because in China, you know, interestingly, I talked to a lot of people that I know from mainland, and a lot of them they work in a fund, you know, management organization for a while, and then they come out and start their own private equity fund. To me, that is kind of a strange phenomenon, because a lot of these boutique shops are setting up and then, you know, kind of getting the money from high net worth and then trying to, you know, play in the local market. I think we need to, I think going back to the original fundamental in terms of mutual fund, this is supposedly, you know, for long-term investment, diversification. It's not a way to participate just in the IPOs and, you know, try to, you know, kind of do all these short-term speculation.
Before we round up this panel, we have to look at the outcome of the poll. I mean, this is your chance to have your voices heard. So don't say that we regulators don't give you a chance. Like, show it up, bring it up on the screen. What do you say on the 2 questions? All right, so out of those votes, 37% thinks that Southeast Asia has a lot of potential, and North Asia as well, whereas US is 17%, and major markets is only 12%. All right, the second questions on the multiple channels of accessing. Wow, well, all right, we're doing all right here with the mutual regulatory. We've got 44% of those voted in favor of cross-selling and mutual recognized, under mutual recognized schemes and sailing to the northbound. I guess quite a number are waiting to be approved right now. So I hope that CSRC hear that. And then we have 21% investing in the joint venture and on the mainland, and the Wolfies got 20%, and the UCITS 15%. So good. Let's give a round of applause to our panelists. Thank you. Thank you very much. It's very good.